Good afternoon, Benedict and Christina. Yeah. Good afternoon. Good afternoon, 박정인, 장재웅, Clara.
Good afternoon, Professor.
Good afternoon. So the weather is not that sunny here, so maybe we have a little bit of influence from typhoon, which is going through Japan, I think. So you see this picture. I think this time around it is very best time to in the sky at night. Best time to see, yeah, the stars. If you have a good, very good telescope, yeah. I got an email from one student saying that it would be better to give a more explanation on the yield to maturity. So when I ask you guys if you guys have any questions, so you guys usually be silent, right? But actually you have many questions in your mind, right? So if you don't understand, then please ask me. Just say I don't understand, so please explain again, a bit easier way. So please ask me. So I tried to, yeah. Just a minute. I tried to explain as possible, as easy as possible, right? So, what time? Okay, well, let's get started. Today, we are supposed to talk about equities, but I think many of you may a little bit struggle with the concept of bond valuation. So I tried to explain the concept of yield to maturity, and we're gonna take some examples for valuation of bonds and Q&A session, yeah, including the answers to the questions from lecture 2, which I sent you guys yesterday. Okay. Okay, first of all, yield to maturity. As the terminology says, this is the return, yield or return, right? Simply speaking, return to maturity. So as you know, the bond has a fixed life, fixed investment period, right? 1 month, 2 months, 10 years, 20 years, 30 years, right? We have a variety, various types of various periods of bonds, right? So it has a fixed period. So another feature of a bond is that it has a coupon, right? Coupon, and it has fixed period maturity, fixed maturity. It has a maturity. It is mature at some point, right? Coupon, we have a coupon maturity and yeah, principal amount. Right? And versus this fixed income bonds is it subject to the fluctuations of interest rate, market interest rate, right? Interest rate. Not just interest rate, interest rate and credit and so on. But among the many factors that influence the price of the bonds, the interest rate is the biggest one. Most, yeah, the biggest one. So market interest rate changes already. It already changes. Yeah, it always changes depending on the economic conditions, right? But for example, right now, in most countries, the inflation is the biggest problem for the central bankers to tackle, right? So interest rate is getting higher. So, but coupon rate doesn't change at all. Once coupon rate is set, then it doesn't change, right?
Professor,
Yeah.
can you explain from the beginning, because you started right at 30 minutes and I didn't have time to log in and I heard nothing because I have bad connection here in Solbridge. Can you repeat again?
Yana, you spoke too fast and you sound a little bit broken. Could you say again?
At Solbridge, internet is really bad, so I didn't hear anything because it took me 3 minutes to log in the session and you started lecturing right in 30 minutes. So we didn't have time to log in. So I missed all the information you was talking about up to this point.
Oh, okay. I'm sorry that you have problems with the internet. But I uploaded the previous lecture into the LMS site. But yeah, okay. 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 In the last week, in the last lecture, we talked about the valuation of a bond, right? The first of all, you guys understand the features of a bond. As I said, a bond is one of the fixed income, right? The most representative product of a fixed income is a bond. Bond. Why we talk about bond? Because bond or stock. The company, if you look at the balance sheet, right? Balance sheet. On the left side, we have asset, right? On the right side, liability and equity. So this asset is financed with the liabilities or equity, right? So liabilities, if you have a credit line with the bank, then you make a loan, you take a loan from the bank, right? But the other way of the debt financing is issuing bonds, okay? So on the liabilities section, you may have you may find some loans or some long-term debt, right? Loans or long-term debt. So long-term debt usually usually take the form of a bond, right? And equally, if you issue stock, then the investors also, if investors are interested in this company, then they're gonna purchase the stock issued by this company. So there's two ways of financing assets. One is the bonds, or the other way is stock. So today we are supposed to talk about stock, but previous week we talked about bonds. And the features of bonds, as I said, it has a fixed period of life. It is matures at some point. Let's say 1 month, 2 years, 10 years, 20 years, 30 years. So some bonds has a maturity of 100 years, right? Depending on the capacity of the company or credibility of the company. So fixed period, it has a fixed period of investment, fixed investment period. The other one is it has a fixed interest rate, coupon rate. So coupon means that during the fixed period, usually annually or semi-annually, it is supposed to pay interest or coupon payment, right? And this coupon payment, the coupon rate is fixed when the bond is issued. Let's say 10%, 5%. So over this life, the coupon payment does not change. It is fixed. Let's say, and it also has a principal. So if the principal is 100, so then every year you are supposed to receive $5 of coupon payments. So once the bond matures, then you receive the $100 principal back, and the last coupon payment $5. So at the maturity, you're gonna have a cash flow of 105 points, for example. So that is the primary features of a bond, right? So but the difference between stock and bond is that you do not have any other profits, any other cash flows, but this coupon payment and repayment principal. But if you have a stock, right? If you have a stock, depending on the performance of the company, you are supposed to have dividends, not only dividend, but also when you sell this stock, the dividends, accumulated dividend will return to you in the form of a capital gain. So what I'm saying is that stock does not have any fixed period of life, right? As far as the company exists, you still the life of stock does not end, right? So there's no maturity of the stock. There's no as far as the company is going concerned. So the stock doesn't have any fixed life as a bond, and the value of the stock is based on the performance of the company. But bond, the value of a bond is not based on the performance of the company. Yeah, it could be but still bond is subject to the credibility of the bond, credibility of the company. But mainly the bond is the price of bond is more influenced by the interest rate, market interest rate. Why? Because main cash flow you receive from bond is coupon payment, right? So coupon payment is kind of an interest payment you receive on the bond, right? So you compare market interest rate. So in terms of the pricing of a bond, you should compare market interest rate with coupon rate, right? But we do not, but yeah, so it's simply speaking, we need to, we may first compare the market interest rate with the coupon rate, right? Let's say in this case, 5%. So market interest rate, let's say 10%. Oh, then this coupon rate is pretty low compared to current market interest rate, right? So then, as an investor, when you in terms of a pricing, in terms of a value of this bond, because the market interest are 10%, this coupon rate is 5%, right? So then the price of this bond supposed to be lower, right? As an investor, if you invest $100 based on the current interest rate, you can make $10 per year. But if you receive only if you receive over $5 based on 100, then you're gonna lose money. You're gonna lose $5, right? So the price of the bond should compensate for this loss, $5. So if a market interest rate the same as this 5% coupon rate, then the price of this bond would be this par amount, 100. But since the market interest rate is higher than coupon rate, the price of this bond supposed to be lower than this par value. Let's say par value is 100. Okay. So that's the relationship between coupon rate and market interest rate, but it is not quite precise simply to compare market interest rate only coupon rate. What is the more the correct comparison of the correct so it is more precise to compare the market interest rate with actual rate of return from investment in this bond. So actual rate of return is called yield to maturity. Okay, so we do not simply compare coupon rate with the market interest rate, but we are going to yield to maturity or yield to market interest rate. Or the yield, basically, yield to maturity is actually a market interest rate, basically, because the price, as far as the price is market based, then the yield to maturity is going to be a market rate. So let me explain this way. Just a minute. Okay. Let's take a look at this one. This is the article I took today. The bond yields rise. 2-year Treasury tops 3.85% on higher Fed rate hike expectation. So this article says that 2-year maturity is 2-year. So this bond, a Treasury bond, matures in 2 years. The 2-year Treasury tops 3.85, so more than 3.85. So the Treasury yield is 3.85% because of the higher the expectation of a higher interest, higher Federal Fed is a Federal Reserve Bank, the higher the expected higher the federal rates, yeah, in the future. Bonds. So this is from the CNBC. U.S. Treasury. U.S. Treasury is a government bond. Okay, government bond. U.S. government bond. U.S. government bond. Then you see U.S. 1 month, 3 months, 6 months, 1 year, 2 years, 3 year, 5 year, 7 year, 10 years, 30 year, yeah, 20 year. So this is a maturity, right? Maturity. So U.S. Treasury has this variety of this variety of maturities. Let's see, 2 year, 3.95, 3.3, yeah, more than 3.85. So 2 year, 3.9, 3.9, 3.95, right? So more than 3.85. So a little bit difference. Okay, that doesn't matter. So here you can see yield. So if you purchase, right? If you purchase this 2-year bond and hold it to the maturity, then you wanna get a return of 3.95%. That's what it means. Okay, so then where it depends on depends on your investment strategy. But if you find 3.9%, 3.95% of a return on the investment in the bond is good, then you want to purchase this bond. But one thing you should consider is that what is going to be the future interest rate, right? Let's say if the future interest rate within 1 year is increases steeply increases, then you're gonna may lose. Then at some point you're gonna sell this bond and purchase another higher yield bond. So things are gonna change in the future. Anyway, what this yield means is that if you purchase this 2-year bond, 2-year Treasury bond, 2-year Treasury, and keep it until the end of the until the bond matures, then in the end you're gonna have a 3.9% return. Let's say 10 years. Okay, let's take a look at 10-year bond. 10-year bond is 3.494 or around 3.5%, right? This you see, same, right? 3.494, 10-year Treasury, right? It's unchanged. I mean, this yield is a market yield. Its yield changes every day, but not much significantly because yeah, the interest rate is too much changes interest rate. It has caused a lot of problems. So anyway, so you see the price, the coupon, okay, coupon rate is this 10-year bond, sorry, 10-year treasury, coupon rate is 2.75%, okay? And maturity, 10 years. So matured, yeah, in 10 years, 2032, August 15. So it means it was issued 2022, right? August 15. So if you purchase right now, right, this 10-year treasury bond at this price, right, you're gonna have return of 3.9494%. Why? And the principal amount is par value is 100. Okay, so why price is lower than a par value 100? Why? Why par value is price is lower than par value? Why? Why? Because coupon rate 2.75, but market yield, the market interest rate is 3.494, higher than coupon rate, right? What the textbook says is that, oh, okay, but textbook does not talk about this chart. They talk about, we don't know this, we only know this price and the coupon rate and the maturity, and the par value is 100. So that's all we have at the moment. Then what is gonna be the yield to maturity if you hold if you keep the bond to the maturity when you purchase this bond at this price? So what is gonna be yield to maturity? So you remember discounted cash flow, right? So present value is, this is current price. Present value is 93.8125. This is the present value of the cash flows, this 10-year bond. Every year, you are supposed to have $2.75 for $100, right? Let's say you may purchase more than 100, more than one bond, maybe 100 bonds. So total investment must be huge, much more higher. But let's say if you just purchase only one bond, only one 10-year bond, then every year you're gonna receive $2.75 every year, right? And last year, 2032 August 15, you're gonna have a 2.75 plus 100, right? So this is cash flow up to during the life of this bond, 10-year bond. Then you need to discount this cash flow, right? To get this the current the present value, right? You remember time value of money. Then you need to discount this cash flow, annual cash flow, right? But we don't know this discount rate. But this discount rate is the yield to maturity. So this discount rate is, if you put this 3.49494 to this, then you can get this 93.8125. Okay, coupon rate was 2.75, right? And the par value was 100, right? And the price was 93.8125, and the maturity is 10 year, right? So the yield to maturity, let's calculate yield to maturity. Formula, finance, and let's go to rate. Rate. Okay. 10 years. Payment. Payment. Coupon payment every year, right? And the present value, 93. The present value, so we have to pay, right, to purchase this bond. So sign, negative sign. And future value, future value. What is going to be future value? Par, right? And so future value 100. Once the bond is mature, so you want to receive $100, right? That's why future value is par value. And then you want to receive at the end of the period, so you don't you simply leave this blank. Then 3.494, right? 3.494. So you guys get it? So simply speaking, yield to maturity is the rate of return when you make investment in the bond based on the market interest rate. Based on the market price, sorry. Based on the market price of the bond. It looks a little bit simpler, but as you go deeper and deeper into this the fixed income, things are really complicated. But anyway, this is the kind of way to understand the concept of yield to maturity. Any questions?
Professor, I have a question.
Uh-huh.
I was a bit wondering the relationship between the yield to maturity and the market interest rate. Does these two is the same or they have some difference?
No, price and the market interest. Price of bond versus market interest rate is the inverse relationship. Price of bond. Price of bond.
The market interest rate. Yes, I know the price of the bond. I was just wondering the market interest rate. Is this has any relationship with the yield to maturity?
Okay. Yeah, definitely. This just a minute. Okay, so this is a treasury bond, right? This is treasury bond. So Hmm. This is treasury bond. Treasury bond have usually the only risk the treasury bond has is interest rate risk. Interest rate. But when we talk about corporate bond, okay, corporate bond, corporate bond yield to maturity, right? Corporate bond yield to maturity would not be the same as this one, even if it is the same maturity of 10 years and coupon rate is 27.75. Let's say let's say a company, let's say coupon is the bond, right? With the same maturity as 10 years and the same coupon rate of 2.75, okay? So then the price would be the same, and then the price would be the same as the 93, as this, the 10-year treasury bond? No, it's not the same. Could be lower. Why? Because the corporate bonds has not only has this interest rate risk, market interest rate risk, but also credit risk, and all other types of risks, liquidity risk, credit risk, all types of risks, rather than compared to this treasury. Treasury bond is almost is secured by the government, so almost no credit risk unless the U.S. government default, but there's no chance to go U.S. government default, right? So this is market interest rate. So all the yield maturity you get from the treasury bond is the market interest rate on market interest rate during for this maturity, right? But when you make a valuation, yes, but when you make a valuation of other bonds, other bonds than the treasury bond, yeah, the price of the bond would be definitely affected by these market interest rate, but also other risks. So these risks are in the end reflected into yield maturity of the corporate bond. Okay, so that's
Yes.
why the relation. So as the market interest is getting higher, and the coupon rate is the same, right? But as the market interest is higher, the price of the corporate bond would be getting lower. That's the relationship between market interest rate and the price of bonds. As well as the bond has other risks, as well as the bond, yes, yeah. So yeah, so it's okay.
Yes.
Okay.
Yeah, I understand. Thank you.
Yeah. Any other questions? So you basically that's why it is very important to understand the time value of money. Ayana, are you fine? Yana, are you there?
Yes, I'm here, but I'm listening from another computer because I cannot hear the lecture from mine. It does not like catch the Wi-Fi here.
So you still have the difficulties with some technical difficulties. We still have some technical difficulties. The sound is not good.
Like I'm at Southbridge and there are a lot of people here, so Wi-Fi is not good for like. Maybe it's my problem, but I cannot hear you. So I'm listening from another device.
So how about Okay, so as far as you can hear me. So any question about the no? Okay.
I'm okay.
Okay, so if you guys interested in bond, please visit the CNBC bond section, and this is yield curve. Yield curve is also very important. And this is a current yield, and this is 1 year yield. So simply, you see, right? Every maturity interest rate has increased a lot in just 1 year. So this is reflection of inflation, right? So inflation, that's why sometimes people said inflation is good for debtors. Inflation is good for debtors. Okay. Let's take some examples. A portfolio manager is considering the purchase of a bond with a 5.5% coupon rate that pays interest annually and matures in 3 years. If the required rate of return on the bond is 5%, the price of a bond per 100 par value is closest to what? What? A? Any chance that A is gonna be answered? No, right? No, because the coupon rate is 5.5% and the market rate is 5%. So coupon rate is higher. So par value is 100. So at least the value of the price of bond should be higher than 100, right? So either B or C, right? But you need to some calculation. So you need so that's why you need to calculator or Excel or the Excel. So I don't know, maybe this one, maybe. So do your own calculation, okay? Or using the Excel, okay? A zero coupon bond matures in 15 years at a market discount rate of 4.5% per year and assuming annual compounding. Annual compounding means annual coupon payment. The price of bond is 100 par value is the closest to closest to, we also need to calculation. Please do the calculation, okay? And let me know what the answer is. Okay. It's simply speaking, you should discount, right? 100, 1 plus 0.045, 15 years, right? This is what you have to do to get, because this is zero coupon bond. So there is no coupon payment, right? We have only $100. We want to receive 100 only in 15 years. That's the only cash flow. So that's why you just need to discount $100 at this rate, 15 times. So I don't know. Okay. Exercise 3. So bond A, B, C, coupon rate 6.68%, maturity is 10.55. All three bonds are currently trading at par value. Trading at par value. So the price is 100, right? Relative to bond C, for 200 basis in decreases in the required rate of return, 200 basis means 2%. This base usually in the market, in the bond market, you usually basis point. Basis is 100. Okay. Is correct. 0.001%. Oh, sorry. Right. So 200 basis point is, so 100 basis point is 1%. Okay. The 1 basis point is, right? Okay. Same. So 2% decreases in the required rate of return, bond B will most likely exhibit bond B. We compare bond C with bond B. Relative to bond C, for the bond B's coupon rate is 6%. Bond C's coupon rate 8%. Okay. And then the interest rate, market interest rate decreases 2%. So then, relative to bond C, bond B's price will most likely exhibit A, equal percentage price change, B, a greater percentage price change, C, a smaller percentage price change. I think this one should, this question should come after for understanding of this the relationship between bond price and the bond characters. So I'm gonna yeah, take this question after explaining this part. Okay. Which bond will most likely experience the greatest percentage change in the price? I think this one is a little bit difficult for you guys right now. Let's take this questions from the textbook. Is the yield to maturity on a bond the same thing as the required return? Is the yield to maturity the same thing as the coupon rate? Suppose today 10% coupon bond is set at par. 2 years from now, the required return on the same bond 8%. What is the coupon rate on the bond now? The yield to maturity? Okay, so Mikhail, you are there? Mikhail Kuznets?
Yep.
Okay, so the first question, is the yield to maturity on a bond the same thing as the required return?
What is it required to return?
Return is as an investor, when you make an investment, right? This is the rate you require. This is the rate you expect from this investment. So required return is in the market, right? In the market, when you buy, specifically when you buy a product, when you purchase a Samsung Galaxy, whatever, there's something you expect from the gadget, right? Likewise, if you make investment in the bond, in the first place, you make investment to make money, right? So there must be a return you require, you expect from the investment. That is the required return. So the yield to maturity on the bond is the same thing as the required return?
No.
Why is no? You understand the yield to maturity?
Yeah.
Yeah, so yield to maturity is, let's say, yield to maturity is based on market interest rate and other if there's any other risk. So it reflects all the risks and market interest rate and inflation as well. Inflation, as far as unless this market interest rate is not nominal. But anyway, all the risks and the market interest rates are reflected in the yield to maturity. All the risks, not just interest rate, but also default risk, any credit rating risk, any regulated risk. Yeah, all sorts of risks are reflected into this yield to maturity. Yield to maturity is the return you're gonna get from investing in the bond. So then yield to maturity is gonna be the same as a required return or different. Conceptually, does it sound similar? Does it sound similar? Yield to maturity, does it sound similar to the return you require from the investment? What do you expect more than yield to maturity when you make it investment bond? What do you expect more than yield to maturity? Think about it. That's all. Yield to maturity is all I can get from the investment in the bond, in any specific bond, right? You purchase this bond at this specific price, right? You're gonna expect the coupon by 2.75%, right? So based on market federal base rate, this is gonna be maybe a better base rate, right? So then, sorry, this is 2-year. 10-year, 10-year is 3 point, yeah. So based on the federal base rate, the treasury rate is I mean, based on the price and based on the coupon rate, and then without any other risk, but only interest risk, what you can expect is 3.494% if you buy this 10-year treasury bond at this price. So this is gonna be expected return. Expected return is same as required return, right? When you expect something, if you don't like this rate, then you should not buy this treasury bond. You may go to buy some higher yield bond, high yield bond. But the caveat is that higher yield bond has other risks, such as credit risks or liquidity risks, right? So you should take risks in return for higher yield. So yield to maturity is actually the same thing as a required return, basically. Okay. I'm just asking because I fully understand this question may not. I think I cannot give you all the explanations in the textbook because we have limited time. So,
Professor?
yeah.
So in simple words, what is the difference between required return and yield to maturity?
Difference between yield to maturity and required return?
Yes, in simple words, like shortly.
Okay. When you say required return is kind of a general term. But yield to maturity is kind of a specific term, usually used in the fixed income market, fixed income. So required returns as this name said, the return you require, right? So the question basically asks you the return you require in the investment on bond is the same as the yield to maturity. That's the question. So as far as you understand the concept of yield to maturity, then yeah, yield to maturity is the required return.
But we don't understand what is yield to maturity.
Hey, come on. You don't understand yield to maturity? Okay, so why did
Yes, because I didn't hear half of the lecture when I was trying to use my computer to
okay.
join.
So hey guys, please raise your hand if you don't understand the concept of yield to maturity. Please, there's a function of raising hand in this Zoom. Please raise your hand. Okay, 1. How many? 2. Please. Yeah, please. If you don't understand, please raise your hand. Hey, please raise your hand immediately. Don't be shy, okay? Okay. Yield to maturity, yeah. Yield to maturity. Yield to maturity, okay. I understand why it is. Okay, let me repeat. Let me try to explain the concept in a different way. Okay, so we learn the present value, right? And future value. So present value, future value is based on the cash flow, right? So A make investment. A company A need to set up a new factory. They need money, so they're going to issue a bond. Okay, so Yana has some extra money in a savings account, and she is interested in this company. This is chocolate company. She is crazy about chocolate. So, but the condition of this bond is that, okay, if you give you money, if you Yana give money this company $100, then this company will pay you interest $10 every year. Okay, so then in 10 years, we're gonna return this $100 to you in 10 years. Okay, so okay, so she agreed, and so she was fine with the condition. So she made investment of $100 into this company, and in return for that, she received the bond security. So now she has no money in a bank account, but she holds the bond security, and she does not have any money, zero. But in 1 year later, she's gonna have $10, right? Second year, another $10, right? Keep going. So in 10 years, she's gonna have $10 plus $100 back, right? So this is the cash flow, right? Cash flow. So this $10 per year on her investment, on her lending, $100 is a 10%, basically means 10% interest rate, right? But just because you like this company, if you're a wise investor, you do not lend this money at these conditions, right? You also need to look at the market interest rate. What is the market interest rate when you lend money? When lend $100, let's say if Yana lend $100 to a bank, that this company B, right? Another chocolate company, right? Let's say this company gives the coupon rate, offers coupon rate 12%. Another C company also 12%. So most similar companies offers 12%, but only this company offers 10%. But just because she has some favoritism on this company, she's gonna buy this bond. But from an investment perspective, this 10% is not the reflection of market rate, 12%, right? So when she make a valuation of this bond, the rate the discount rate she should use is not 10%, but 12% market interest rate, right? So then if you discount this cash flow 12%, then you're gonna have amount less than $100, right? Because coupon rate is 10%, but market interest rate 12%, 2% higher, right? If the market rate interest rate was 10%, then coupon the value of this bond was the same as the par value, right? Okay. So we know this market interest rate. So that's why we could make a valuation of this bond and could get the value of this bond, present value of this bond, present value based on the cash flows. Are you guys following me? Are you guys following me?
Yes.
Okay. Now, when it comes to yield to maturity, the question is, we know the price, we know the present value, the market price. We know the market price of this bond, chocolate company A. We know the value of, let's say, $98 or $98 when par value is 100. We know the market price of this bond at $98, but we don't know the market interest rate. What is the market interest rate? We don't know, right? We don't know. Just assume that we don't know. But as far as you know, this market price of this bond and the cash flow like this, you can calculate it. You can get this discount rate through the Excel or calculation, through the calculator. So the what you get from the calculation, I mean, this rate is called the yield to maturity.
So it is average market interest rate?
This is market price. Okay, this is a market price.
This is market price for company A only.
Yeah, market price. The market price is supposed to reflect interest rate into the value. The market price is supposed to reflect market interest rate, right? But we don't know what the market interest rate is. We only know the market price of the bond, right? So one is missing. Missing is market interest rate. Up to now, we haven't given the market interest rate, discount rate, market discount rate. We haven't been given market discount rate. So that we could calculate the present value based on the market interest rate. When we make a present value, we didn't use the coupon rate. We didn't use the coupon rate as discount rate. We used the market rate as discount rate, right? You remember? Present value is, as far as if the market interest rate is the same as the coupon rate, then okay, you can yeah. So then the present value would be the same as the par value of the bond, right? But at this moment, for the sake of understanding the yield to maturity, we don't know the discount rate, but we only know the market price of this bond. So then that's why yield to maturity implied return of rate. So then we don't know. So then if you get this discount rate, that is the yield to maturity. Yield to maturity is that we have these cash flows up to the maturity, right? And if you discount this rate, then you're gonna have a market price of this bond. So if you purchase this bond at this market price, which produces this cash flows, you want to expect this rate of return, yield to maturity. Yield to maturity. You're gonna, the yield to maturity is a total rate of return until the yield to maturity is the return you wanna get from investing in the bond and holding it to maturity.
So it is like everything we can get with the bond, like the coupon payments and the face value minus the market interest rate.
Minus? What do you mean minus?
But like, I don't understand how market interest rate is connected with the bond.
Okay. Interest rate is connected. Why interest rate is connected with the bond price? That's what you. That's your question. Interest rate. Interest rate. Okay. Interest rate. Okay, let's say it this way. The bond is issued, right? Bond is issued. So then investors in the primary market, right? Primary market, the investors purchase this bond, and this bond is going to be traded in the secondary market. Okay, so then they usually, but this bond usually traded at price. Yeah, this bond is traded at yeah, this bond is traded in secondary market, and unlike the stock market, in the bond market, the price is usually quoted in the yield, right? That's why we have this big letter, big numbers, and the price number is pretty small, right? So in the bond market, the price, how to say, they usually look at the yield rather than price, because they focus on interest rate, right? They focus interest rate. Okay. So then, why interest rate has any connection with bond price, right? Because interest rate is opportunity cost. I mean, interest rate is in the bonds. Interest rate is the cash flow you expect from the bonds, right? So if interest rate is, but the bond, but the cash flow bond is mainly coupon, and yeah, mainly coupon. Some we have also zero coupon bond, but the main cash flow, the interest we receive from bond is coupon, right? But coupon rate is fixed. There is a floating coupon rate, but for the time being, we are talking about fixed coupon rate. So fixed coupon rate, so then fixed coupon rate means that the cash flow over the year, over the maturity, the cash flow is fixed, right? But interest rate means that if market interest rate higher than coupon rate, so then you lose some money in terms of opportunity cost. Let's say you purchase the bond with a coupon rate of 5%, and but right now the market interest rate 10%. So if you invest the same amount of money in other products, then you're supposed to receive $10 rather than $5, right? So then there should be some compensation for the loss of money, $5, right? That is reflected in the price of the bond. So we now have like this price. This price is less than 100. Why? Because coupon rate is lower than the market interest rate. This is compensation for the loss of interest. This is compensation for the opportunity cost. If you go somewhere else, you may have a chance to have just make money of 3.494%. Let's say yeah. Am I not clear? So the relation, why the interest rate has any connection with the bond? Because interest rate is market interest rate is discount. Market interest rate is supposed to discount all the cash flows of bond, but the cash flow is the coupon, right? The coupon rate is fixed during the life of the bond. So if interest rate is high, market interest is higher than coupon, then the price of the bond is lower. Given that, based on that information, based on the knowledge, with the knowledge, if you know the market price of a bond, then you could get the discount rate, market discount rate, through using the calculation or the Excel. So what you get from the calculation is the yield to maturity, because we suppose that we are going to hold the bond up to the until the bond matures. But still not clear. I think maybe not clear. I fully understand. I fully understand. Yeah, fully understand. So yeah, I fully understand. Perfectly understand. But we need to move forward. But I think to maturity. Still not clear, right? Right? Still not clear. So, please ask me what is not clear. Then I will try to explain further. It's okay, perfectly okay. I also make a mistake, as I did here. I made several mistakes, and I also ignored some information. So one of your students, smart students, pointed it out. I'm very pleased. So please challenge me always. I make mistake. I have to correct my mistake, but making a mistake is not a thing that you should be ashamed of. What you should be ashamed of is just to pass it over without seeking just pass over without I mean trying to making any correction, or trying to know what is correct without trying to know what is correct. So making a mistake is always very common, and pointing out my mistake is always very common. That's great, because there's also another chance that you're gonna learn something new, or refresh your knowledge, whatever. Okay. So please mail me, okay, if you do not want to say right now here. If there's anything unclear about immature, then I will try to explain, another way. Today, so we almost consumed the entire lecture talking about maturity. So I fully understand maturity is not easy to swallow at once. Okay. Did you guys had a chance to take a look at this question? Actually, I made a mistake here. I actually made several mistakes. So I made a mistake here. One mistake I made is that here I ignored this part. Ignore any tax loss carry forward provision and assume interest expense is fully deductible, right? So here, if you deduct this cost of goods and administrative expenses, depreciation, interest, that you have a minus, you have a negative net income, right? Actually, net loss. But if you multiply net loss with 21%, then you're gonna have a tax. You're gonna have actually tax loss, right? But here, in most cases, if you have a tax loss, it is under the tax law carried forward, right? But here, ignore any tax loss carry forward provision. So the question says that you don't have to take account of this tax loss of $44,100. Just ignore this amount, right? So then the tax is supposed to be 0. Okay, so then 1 minus 0, and not this one, 2,100. 110,000. Okay, and then a plus, sorry, this is minus 210,000, right? And then the rest is the same. No tax. Tax is 0. Okay. So what makes difference between A and B is depreciation and the interest. Okay. Am I correct now? If I still make mistake, then please point it out. Okay. So I'm gonna do this in the beginning of the next class, and then we are going to talk about stock market. Stock market is the stock. Stock is relatively easy. Because the fixed income is pretty complicated as you go different. So the fixed income traders are usually more smarter than the stock traders, okay? Because they derive, but the stockbrokers are very optimistic, but the fixed income traders are a little bit pessimistic, okay? Because they should be pessimistic. Otherwise, if they pessimistic, the interest is getting lower, then bond price is getting high. So that's why this may be one of the reasons. I don't know. Okay. Please email me if you are still not clear about the concept of maturity, and then yeah. And I tried to tackle some other questions. In the big, if you have extra time after covering this stock market, I'm gonna spend a little more time on more time explaining the fixed income portion, fixed income part. Okay, so any question or suggestions?
Professor,
Yeah.
is it possible to like plan to finish the lecture at least like 10-15 minutes before 4 p.m. because we have other in-person classes? We need to find the classroom. We need to drink some water, please.
Okay, I'm fine. So 10, 4:10? 4:10? You want to have make an appointment at
What?
4:10 or 4?
No, Professor, I mean like we finish the lecture 5 minutes before the next lecture we have. So maybe we can finish earlier because we need at least to
Oh yeah.
go
I'm gonna finish.
upstairs.
I'm gonna finish now. I'm gonna finish now. Okay. So if you don't have any more questions, then let's wrap it up. Okay. So see you this Thursday. So if you have any questions, please mail me. Oh yeah. Okay. Thank you.
Thank you, Professor.
Thank you. Bye bye.
Professor.
Thank you. Have a nice day.
Thank you, Professor.
Thank you. Bye bye.